For the past couple of years, the market has been obsessed with just one single word: pivot. You know, that comforting idea that the Federal Reserve is going to cut interest rates any day now, sending all our assets to the moon. But what if the data is telling a completely different story? What if that pivot isn't coming? What if we're all caught in an economic trap that we just can't get out of? Because the numbers, well, they're telling a story most of the market is desperately trying to ignore. And look, this is the brutal truth that a lot of people just don't want to hear. We're not just dealing with some temporary price spike anymore. This is a new reality, a new game where the old rules of investing, they just don't work. The Fed's 2% inflation goal, it's not just a long way off, it's basically a fantasy at this point. You hear it everywhere, right? The dominant story, the one that's been driving the market, is that relief is right around the corner. The Fed hikes rates, inflation cools down, then they pivot and cut rates, and boom, everyone holding stocks and bonds gets rewarded with this huge rally. It's a really simple, really comforting story. But it also happens to be dangerously wrong. Because this number right here, this is the only number that really matters. Forget all the month-to-month noise and the headlines. Core inflation, the one the Fed really pays attention to, has stopped falling. It has slammed into a solid wall right around 3%, a full point higher than the Fed's sacred 2% target. This isn't just a layover. It's looking more and more like the final destination. This chart tells a story that should honestly keep investors up at night. Yeah, we had that steep drop from the peak, which was great, but inflation didn't keep falling. It's hit a brick wall. The rate hikes did their job initially. They broke the crazy momentum, but they haven't been able to land that final knockout punch. This flatline, this is a completely new and, frankly, a much more dangerous problem than that first spike. So you might be wondering, if it's so obvious, why isn't the market totally panicking? Well, it might be because the official numbers are kind of masking the real problem. The government is telling a slightly rosier story than reality, and to understand why, you got to see how the sausage gets made. So back in early 2023, the Bureau of Labor Statistics quietly tweaked how it calculates the Consumer Price Index. They used to look back 24 months for seasonal adjustments. Now they only look back 12. So what does that do? Well, it means they effectively dropped a whole year of higher inflation data right out of the calculation. By doing that, you raise the baseline you're comparing against, which makes the current year-over-year number look smaller. The official reason was for accuracy, but the effect was a subtle but pretty powerful shift that made the numbers look just a little bit better. Okay, so even with the official numbers being massaged a bit, the problem is still obvious. So why doesn't the Fed just hike rates even higher and crush it once and for all? The answer is simple. They can't. They are completely paralyzed, trapped in one of the worst economic scenarios you can imagine. And this is the perfect way to picture the Fed's position. Think of it like an endless arm-wrestling match. On one side, you've got crushing inflation that's just eating away at everyone's savings. On the other side, you've got a devastating recession that would destroy jobs and businesses. The Fed doesn't want either side to win. Their goal isn't victory, it's to keep this match going forever, which means keeping the economy in this state of permanent tension. This is the classic lose-lose choice the Fed is facing. If they cut rates to give a boost to a slowing economy, they risk inflation taking off and spiraling completely out of control. But if they hike rates even more to fight that sticky 3% inflation, they could easily tip us into a really painful recession. There are no good options here. This is the textbook definition of stagflation. And you know who knows it? The bond market. If you look at something called inflation break-evens, which is basically what the bond market thinks future inflation will be, it is not pricing in a return to 2%. It's pricing in this exact dilemma. We've seen this movie before. In the 1970s, you had loose money policies smashing into supply shocks from oil, and it created a decade of misery. Every time they tried to stimulate the economy, it just made inflation worse. The whole thing only ended when Fed Chair Paul Volcker made the absolutely brutal decision to hike rates to almost 20% on purpose, causing a massive recession just to finally reset everyone's expectations. That's how hard it is to get out of this trap once you're in it. Now, let's clear something up really quick. You might have seen some headlines flying around claiming the Fed officially abandoned its 2% target. That's misinformation. What they actually did in 2023 was abandon their average 2% target strategy from 2020. That was the one that allowed inflation to run a little hot for a while to make up for times it was too low. They got rid of that idea and went back to a straight 2% target. So the crucial point is they're still officially aiming for 2%. They're just completely failing to get there. So this brings us to the core of the problem for you as an investor. This new 3% world creates a pretty devastating trap, especially for people who think they're playing it safe. And it all comes down to one concept: real yield. Simply put, real yield is the only return that actually matters. It's not about the fancy number you see on your account statement. It's about what that money can actually buy after inflation takes its slice of the pie. It's the only true measure of whether your wealth is actually growing or shrinking. Let's just walk through the simple math. Let's say you buy a quote-unquote safe government bond, and it's yielding 5%. That sounds pretty good, right? Not bad. But with inflation stuck at 3%, you have to subtract that from your return. So your real yield, your actual gain in purchasing power, is just 2%. A 2% real return is not a safe harbor. It's more like a slow leak in your financial boat. You're barely treading water, just barely outrunning the erosion of your wealth. In fact, a lot of so-called high-yield savings accounts and bonds out there are actually giving you a negative real return. You are literally paying the bank for the privilege of losing your money slowly. So this is the really tough question every single investor needs to ask themselves right now. Most retail investors are holding long-duration bonds for one of two reasons: either for the yield, which we just showed is getting eaten alive by inflation, or they're hoping for that pivot, that big rate cut rally, which all the evidence suggests is just a fantasy. So why are they in your portfolio? This new reality has a direct casualty, and it's a big one. Probably the single most common investment strategy on the planet: the classic 60-40 balanced portfolio. For decades, this was the bedrock of financial planning, and it worked beautifully during a 40-year bond bull market where interest rates just kept falling. The idea was so simple and elegant. Stocks were for growth, bonds were for safety. When the stock market freaked out, investors would run to the safety of bonds, pushing their prices up and cushioning the fall. And this is what it looks like: 60% in stocks for that growth, 40% in bonds for that stability. It's the default setting for millions and millions of retirement accounts. It was designed to smooth out the ride. But the entire foundation it was built on, it's got a massive crack in it. Persistent inflation is the kryptonite for the 60-40 portfolio. Why? Because the only real way to fight it is with higher interest rates. But higher rates are bad for stocks, it makes borrowing money more expensive, and they are absolutely devastating for existing bonds. That negative correlation, that fundamental promise that when one goes down, the other goes up, it just vanishes. In this new world, stocks and bonds can and absolutely do fall at the same time. Okay, so if the old model is broken, what's next? We can't just hide in cash and let inflation eat our lunch. We need a new playbook, a new framework for how to invest in a world where inflation is a permanent feature, not just some temporary bug. This quote cuts right to the heart of the new strategy. In an inflationary world, two things matter more than anything else: the ability to raise your prices without your customers leaving, and not needing to spend a ton of money just to keep the lights on. So what does this new playbook look like? It's all about resilience. First, it means you gotta favor businesses with real pricing power. Think of strong brands that can pass on rising costs to customers. Second, you want to avoid those super capital-intensive companies that have to constantly spend a fortune on new factories and equipment, because that stuff just gets more and more expensive every year. Third, it might mean looking beyond just stocks and bonds to tangible assets that can hold their value during inflation, things like commodities or infrastructure. And finally, the golden rule: obsess over your real after-inflation return on every single thing you own. That is the only number that really matters at the end of the day. And this is the ultimate takeaway. The market conditions that built the portfolios of the last 40 years, they're gone. The era of falling interest rates and stable, low inflation is over. We're in the 3% trap now, and the rules of the game have changed. The only question left is, will your strategy change with them?